Hey everyone, there's a silent shift happening in the stock market. While retail investors are busy chasing momentum stocks, institutional investors, both FIs and DIs, are quietly increasing stake in select companies. And what is even more interesting is that public holding in these companies is consistently falling. So what's happening behind the scenes? Why are institutions getting aggressive? In today's video, we'll deep dive into 8 such companies. From 100-year-old traditional businesses transitioning into new age sectors to niche tech and financial companies that are quietly compounding wealth. We'll understand their business, what's driving growth, and why institutional investors are betting big on them. But before we proceed further, please note that the idea behind this video is to identify promising companies. However, you need to deep dive to build conviction before investing. Also, there is no guarantee that if institutional investor has increased stake in the past, they would continue to do so. So make sure that you understand both the opportunities and the risk before investing. Alright, let's get started. So the first company in the list is E.I.D. Parry. It is more than 100-year-old company and part of prestigious Murugappa Group. It is traditionally a pure play sugar producer with a strong presence in South India. I remember discussing this company in detail last year when I found that Parag Parekh, one of the most trustworthy mutual fund house, has purchased stake in the company. Interestingly, both FIs and DIs are consistently increasing stake in the company. FI holding is up from 8.7% to now at 12.7%, and DI holding is up from 4.2 to 14.6%. And weak hands of public have gone down from around 33% to now at 24%. But what is exciting about sugar business? Isn't it commoditized and highly volatile? And even if you look at the revenue and profit growth, the growth is not very exciting. Then why institutional investors are aggressively buying this company? So the answer is yes, sugar business is highly commoditized and volatile. But the catch is, E.I.D. Parry is now aggressively transitioning from sugar business to FMCG, biofuel, as well as nutraceutical segment that are less cyclical and margin accretive. The shift include value-added products like brown sugar, low glycemic index sugar, then jaggery, as well as your retail staples like dal, rice, millets under Parry's brand. And this transition has resulted in valuation re-rating. Here please note that in FY25, E.I.D. Parry reported revenue of 31,000 crore, but out of this, only 10% comes from its core standalone business. 90% business primarily comes from Coromandel International, which is one of leading agri-solution provider in India, where E.I.D. Parry holds around 56% stake. Also the fact that since E.I.D. Parry is part of Murugappa Group that has a rich history of exceptional governance along with judicious capital allocation. So it looks like institutional investors seems to believe in E.I.D. Parry transition story, and that probably resulted in valuation re-rating. Currently E.I.D. Parry commands a market cap of around 21,000 crore. Second company in the list is Craftsman Automation. It is one of India's leading precision component manufacturer. Company operates through 3 core business verticals. First is automotive powertrain, where it manufactures parts like cylinder blocks, heads, camshafts, transmission casting for OEMs such as Tata Motor, Ashok Leyland, Mahindra & Mahindra, Daimler India, JCB Automotive. Then second division is aluminum products that offers die-cast and machine parts for passenger vehicle, tractors and two-wheelers. And third segment is industrial and engineering segment, which includes storage solution for warehouses like pallets, racking, shelving, along with various other components that find application across automotive, process industries, elevators, metro, engineering, marine, etc. Interestingly, FIs have increased their stake in the company from 12.5% to 17%. Although there is some selling in last 2 quarters, but it is absorbed by DIs that have increased stake from 16% to now at 22.7%, and public holding has consistently reduced. Financially, its revenues have grown multiple times in last 7-8 years. Although its margins are a bit volatile and hence net profits have also been volatile. But still in last 5 years, its profit growth is 37% CAGR. However, FY25 net profits were down by 30%. Interestingly, company's management has guided for a top line of 7,000 crore by FY26 that would translate to a potential 33% revenue growth and around 1100 crore EBITDA, that is around 30% potential growth over FY25. Currently it commands a market cap of around 15,000 crore. P is looking high, but it's not an ideal metric as Craftsman is into capital intensive business with high capex and depreciation. Oh, by the way, the platform that you see me using is ScanX, our partner in today's video. It's a great analysis plus screener based platform. Plus, it's a free and easy tool. This platform is part of Dhan, which is among top 10 brokers in India. If you have Dhan account, you can get full access to use ScanX absolutely free. And if you are planning to start mutual fund or stock investing journey, Dhan platform is absolutely free for you. They don't charge account opening fee, AMC or commission on delivery and mutual fund. For intraday trading, there's a flat fee of 20 rupee or 0.03% of trade value, whichever is lower. I was exploring its stock platform features, and one particular feature that really stood out was corporate action on watchlist. Since corporate actions like dividends, stock split, bonus, right issue are important events, keeping a track of this is crucial part of investing journey. So on Dhan platform, when any company in your watch list has an upcoming corporate action, you'll find it in your watch list. It can really help to stay informed and make quicker decisions. Now third company is Home First. It's a technology-driven affordable housing finance company with pan-India presence. It predominantly focuses on providing home loan to first-time home buyers, where its major target customer include salaried individual with salary lower than 50,000 rupee. Now, affordable housing is one segment we have discussed multiple times, and one trend is very clear. It's a high-growth sector due to rising urbanization and a trend for nuclear families. Home is always a dream for any person and is still a highly underpenetrated and underserved sector. Even Indian government is pushing for affordable housing. Home First has created a niche in the space with digital onboarding, paperless loan processing and AI-driven underwriting that enable faster and cost-efficient loan disbursals. If you look at institutional holding, FI stake in the company is up from 24% to 37% and DI stake is up from 10% to around 22%. Public holding has reduced massively. Company has been able to grow its revenue and profits at a very fast rate, and management has guided for 25% CAGR growth in loan book for coming years. At the moment, company commands a market cap of around 15,000 crore. Fourth company in the list is Caplin Point. Headquartered in Chennai, Caplin Point is a generic pharma company that focuses on manufacturing tablets, capsules, liquids, ointments, and injectables. Company's around 75% revenue come from Latin America and remaining from Africa and US. Interestingly, 13 years ago, 95% of company business was from generic medicine. But thanks to company's focus on innovation with R&D, now 25% business come from branded generic. As a result, company has witnessed massive growth in operating margin from 20s to now in 30s. Due to that, while its revenue growth in 10 years is at 27% CAGR, its net profit growth is at staggering 35% CAGR rate. As a result, Caplin Point has been a massive wealth creator. Yet, it is still a small cap company with market cap of around 16,000 crore. It's completely debt free and valuations are also reasonable. Company's promoter holds significant 70% stake in the company, but last few quarters, public holding is consistently reducing and both FIs and DIs have increased stake in the company. Going forward, one of the key growth drivers for the company is their entry into regulated market of US and Europe, where it has already received multiple US FDA approval for injectables and ophthalmic products, and there's a strong pipeline of new product launch. Also, company is moving towards more complex products with higher entry barrier, fewer competition and longer product life cycle. Fifth company in the list is City Union Bank. It is one of the oldest private bank in India with more than 100 years of history. Now you might ask, Sahil, if it is that old, why its market cap is still only 15,000 crore? So the reason is because the bank has largely focused on Tamil Nadu and nearby South Indian region with very conservative lending practice. Bank also lacked focus on digital innovation. However, in last few years, bank has ramped up its digital banking platform, launched fintech partnership, and it's modernizing core banking operation. Also, bank has been gradually expanding its presence to Karnataka, Andhra Pradesh, Maharashtra and beyond, and focusing on SME and retail lending. Now, it is one bank that has a clean balance sheet with strong asset quality. Plus, its valuations are not very expensive at price to book of 1.7. If you look at shareholding, DI stake in the bank is up from 29% to 35%. FIs have slowly increased the stake in the company. Net, public holding has reduced from peak of 34% to now at 28.8%. Sixth company in the list is LT Food. Now, LT Food is a 70-plus-year-old company best known for the Daawat brand in India. But its business goes far beyond just packaged rice. The company is present in over 65 countries with key revenue coming from US and Middle East. Company operates across three segments. First is Basmati and specialty rice, which is their core business. Second is organic food ingredients via Nature Bio Foods. Third is convenience and value-added products like ready-to-heat rice, rice-based snacks, etc. With an asset-light global model, strong brand equity and stable margin, LT Food is positioning itself as a long-term agri-FMCG growth story. FI's stake in the company has consistently increased from 5% to 10%, DI's stake is consistently up from 3% to 7%, and public holding has reduced significantly. In last 5 years, company has grown its revenue by 16% CAGR rate and profits by 26% CAGR rate. LT Food is transforming from a commodity rice player to a branded global food company. Its strong brand portfolio led by Daawat in India and Royal in the US ensures pricing power and customer loyalty. Company's export-heavy model, which is more than 65% revenue, gives it access to high-margin international market. While its push into value-added products, organic foods and health-oriented variant is driving premiumization. With a vertically integrated supply chain and rising global demand for basmati rice, LT Food is well positioned for steady and profitable growth. Currently, company commands a market cap of around 17,000 crore. Seventh company in the list is Affle 3i. It's a global technology company that provides consumer intelligence platform. Its primary business is enabling advertisers to drive user engagement, app installation, and online conversion using data, AI, and analytics. Affle earns revenue through its cost per converted user model, meaning it only gets paid when a user completes a specific action like installing an app or purchasing a product. This performance-driven model makes it attractive for advertisers. If you look at institutional holding, FIs are extremely bullish, where they have consistently increased stake from 14.8 to 18.4%, and this is especially when FIs are the net seller from Indian market. DI's stake has kind of remained constant with small fluctuation, but net public holding is down in last few quarters. It seems FIs are quite bullish on rapid digitization and growing usage of smartphone and internet that is pushing brands to increase digital ad spends. Affle uses AI ML to deliver personalized, high conversion ad experiences. Plus, Affle is actively expanding into international market, including Southeast Asia, Middle East, Latin America, and US. Affle has grown at a very fast rate in the past, although the growth has slowed down, but it's still more than 20%. Currently, it commands a market cap of around 26,000 crore. Last 8th company in the list is Gabriel India. It's a leading ride control specialist in India that manufactures shock absorber, struts, front forks, and other suspension system for two-wheeler, passenger vehicle, commercial vehicle, and trains. Company enjoys massive market share of 30% in two-wheeler, three-wheeler, 24% market in passenger vehicle, and 88% market share in commercial vehicle. In EV, it commands 74% market share in two-wheeler and 11% in three-wheeler. In SUV, company commands 65% market share. FI's stake in the company is up from 4% to 3%, and DI's stake is up from 11 to 15%. Public stake is down from 24.6 to now at 19.8%. Financially, company has grown its revenue and net profit at a very good rate. Company is completely debt-free and it currently commands a market cap of around 14,000 crore. Recently, Gabriel India has declared restructuring that will transition Gabriel India from a single segment suspension player to a multi-product mobility platform. So that was a detailed look at 8 companies where institutional investors are quietly accumulating shares while public holding continues to shrink. This usually reflects growing confidence in companies' future outlook, strategy, and management quality. But as always, it's important to do your own research and look beyond just numbers. That is, understand the business, the risk, and the long-term vision. If you find value in this analysis, don't forget to like the video, share it with fellow investors, and drop your thoughts in the comment. Now tell me, which of these companies do you think has the strongest long-term potential? And are there any other companies you have spotted with similar trends? I'll see you next video. Until then, stay curious and keep investing smartly.